everybody, and thanks for watching. Good afternoon. It is 2 p.m. here in Southern California. I'm working more today on my stock market project. I work on this every day, so follow along and subscribe if you're interested in this sort of thing. Basically, I'm working on automated stock market tools, quantitative finance, Python, AI programming. If you're interested in any of that, that's what I'm working on every day. And the goal is to get to the point where I can just run a script every morning, and it'll spit out my picks, and then I can automate, capital allocation in my portfolio. I shouldn't have to touch anything. My job should be monitoring the health of the models. Okay, so let me start by going over the project as a whole. The goals for the project, what I've been working on. I've been working on this for almost 6 months now. What I was working on yesterday, I'm basically ready to start paper trading. So the process is you start with making the model. Actually, let me show the layout here really quick. And so, yeah, I'll go through everything here, and then I'll get into the work I'm going to be doing today. So, what's the goals for the project? First goal is to beat the S&P 500 by a significant margin. So the S&P goes up on average 6% per year. I want to do significantly better than that and get 18 to 24% per year. Additionally, it should be market neutral, so it shouldn't be, if you have something beta leveraged, basically it's doing double the S&P, so if the S&P goes up 5%, your beta leveraged stock will go up 10%. The problem with that sort of portfolio is that when the S&P drops 5%, you drop 10%. So I don't want to just leverage, have a market leveraged portfolio. I want to have something that's truly market neutral. It shouldn't matter if we're in a bear market or a bull market. I can rely on the returns of the model. And so I'm going to accomplish that using a long-short strategy. Basically, you get go long on the best performers, the best predictions from the model, and go short on the worst predictions from the model. And, if the market's going up, then you'll lose, you'll be making more money from the longs than you're losing from the shorts, and vice versa. So this way we can achieve a market neutral portfolio. Now I'm writing all of this in Python code, so I have a secondary goal for the project, which is to generalize the code and open source it so that anyone can build these sorts of models for themselves. And the entire workflow that I have going down here, I generate the universe, create a model, test the model robustly, and implement a portfolio strategy, all in under 100 lines of code. So if you're interested in doing that, you can get the code for yourself. I put the link to the GitHub in the description of this video. Try forking it, downloading it, see how it works. Let me know how I can improve it or what features you'd like to see added to the tool. And of course, if you find it useful, please star the repository. Watch the repository and follow me on GitHub. That helps raise my coding profile, helps me get freelance gigs and coding jobs. So this is the outline for the project. So I have data going back to 2011. You don't want to use all data. And the model needs to predict things that, or you need to basically group things together that are similar. So there's a couple of constraints. One thing is like ETFs move different from common stocks. So Apple and Tesla are going to move differently from some tech ETF. And so that's one thing. The other thing is the model should be scalable. So the ultimate goal usually for quant algorithms is you want to get funded by somebody. You want to start trading somebody else's money. And if you could get 20% per year, they'll let you keep 20% of the returns that they get. So if you can get funded with $10 million and get a 20% return, that's $2 million. And then if you get 20% back on that, that's $400,000 you get as your fee. So if you want to be able to do that sort of thing, you need to do it on stocks. That you need it to be scalable. So it needs to only work on high volume stocks. So those are kind of the requirements for the universe. Now, once you have a good universe, the next step is to create a returns model. You want to predict something like returns relative to the market, returns relative to sector, probability of a positive return, log return, Sharpe ratio, something like that the model should be predicting. And then once you have a good returns model, the final step is to implement a portfolio strategy that you're confident in. Once the portfolio strategy looks good over the back test, so from about 2014 through the end of 2025, the final step is to start paper trading the model. And if the model performs well over paper trading, the next step is to go live, start trading real money. So I've got up to the stage where I'm ready for paper trading. I wanted to start paper trading yesterday. The market opens at 6:30 a.m. my time, and I just started too late. I was working overnight, and I finished writing code at like 5 a.m. And then I went to sleep. I was going to wake up at 6:30 and take my positions for the day, but I slept through my alarm. So I wasn't able to start paper trading yesterday. Monday's a holiday, so I'll be able to begin in earnest on Tuesday. So what I'm going to be working on this weekend is updating the code. One, so that I can start paper trading Tuesday and just run a script at the start of the day. But the other thing is I need to clean up the code base so that all of the changes I've been making to implement the portfolio strategies are available in the repository without adding all the unnecessary code that I've added. So I need to do that. So those are kind of my two goals for the weekend. If I finish those two goals, I'll look more into models and portfolios because I have something that I'm ready to implement, but there's always new things to look at, new research to be done, basically. So that's my plan for the weekend. So let me start with the model I got about a month ago. So I started working on this project at the beginning of the year, really the end of last year. And here's where I was at the end of January. So I had a good model, but it was just too fragile. It wasn't robust enough. So I went through, cleaned up the code base a lot, and I ended up at this model, which I was really confident in for the following reasons. So the first reason I'm confident in it, if you look at the metrics that are highlighted in red, these are the metrics I'm using to assess the model performance. So without getting into all of these, the top one, information coefficient, is giving the predictive power of the model. The rest of the metrics are giving the stability of the model. And suffice to say, all of the metrics were matching or significantly beating the goals I had for them. So the metrics looked really good on this model. So I'm confident in it for that reason. Now, this is just for a single model. It's only testing from mid-2023 through the end of 2025. But the metrics are really good. Secondly, if you look at the decile analysis, the bottom decile is the lowest, worst performing. Top decile is the best, highest, best performing. And that's exactly what we want. It's also monotonically increasing in between, which just means each decile is higher than the previous decile. And that's exactly the behavior we see here. So not only is it good on the metrics, it's good on the decile analysis. And finally, if I do a walk forward on this, the metrics basically train a model for each year from 2016 through 2025. The metrics never fell below their threshold. So for those reasons, I was confident in the model. The next step was to implement some portfolio strategies. I found that basically anything I tried on the single model, which was tested from mid-23 through the end of 25, worked really well. So almost any sort of scaling parameters or whatever I used, I got really good returns for this model from mid-23 through the end of 25. However, when I did this on the walk forward model, I saw that it basically failed from 2016 basically until mid-2023 when it started to do really well. So it's doing well at these later times, but not doing well at the early times. I looked at the decile analysis of the model. These aren't all perfect, so I tried getting some new models. This model, the top model here, was ultimately the best model I had, so I decided to move forward with this. I implemented more portfolio strategies, and I did find something that seemed to work really well. So where's that? Right here. So when I go open to open with this simple strategy, you see the drawdown is under 20% is the worst drawdown, and the duration of the drawdown is only 164 days. So that's really good. The returns are really good. I was ready to go forward with this model. However, So the problem before is it failed from 2016 through 2022 and then did well 23, 24, and 25. So I started looking more into that problem. Um, and where are those results? So uh, here are the decile analyses for 3 different regimes. So this is the early regime. You see the bottom decile is actually outperforming the top decile. It's like flipped from what you would expect. Same thing in 2020 and 2021. However, if we look at 2022 through 2025, we see the correct behavior. So this kind of indicates what the problem was with the model. But because of this, I didn't feel really confident in it. So I went through and did the same thing we have here for the returns model. And basically you see here, this is model 28. So that last model is trying to predict Sharpe ratio. This model is predicting returns. And the first thing you notice is the decile analysis looks really better in the recent regime. But you also see, even in the regimes where it's doing bad, a long-short strategy is still making money, if you look at the middle plot here, because the separation is still good. If you look here at the one I just showed, see the first 2 regimes, it's going pretty extremely negative. And so we don't have that problem when I'm training just a returns model. So for that reason, I've decided to go forward with 2 different models. First, I have this model 28, so that's predicting returns. And then I also have model 25, which is predicting the Sharpe ratios. And then I've implemented several different, or my plan is to implement several different portfolio strategies. And then I'll end up with each one of these will be a unique strategy that I'll be paper trading. And I'll select maybe there's also some nuance to it. So I'll get into that later. That's not that interesting for now. But basically, what I'm going to be working on is creating infrastructure so that I can run each of these models Tuesday morning. And I should get outputs for each of those models, and then I should get something that, saves this. So that's my plan for today. Let me put some music on. Okay, so let's make a list of tasks. Okay, so this is the first strategies are not optimized. Just I'm going to focus on just these ones. So today is the 23rd. Okay. Now let's look at the previous to-dos to see. Need to automate. Okay, so for the paper trading infrastructure, when running multiple models at once, so what is this? 1, 2, 3, 4 times 1, 2, 3, 4, 5, 6, 7, 8, 9. So 36 strategies. Alright, so let's try to make the framework. So what would that look like? First we have what we need is a broad overarching framework. So let's make that. Let's make a flow chart. Okay, so first we have data. Okay, so starting with data. Next, okay, then we send it through the filters. And we create a universe. Next, we take the universe data. So now we have feature engine. Okay, so the feature engine Man, I signed up for some mortgage thing and then I keep getting scam calls. Alright, so we have data from post no preference. Send that into universe filters, use that to create the universe. Then take the full data and the universe, send that into the feature engine to create features. Okay, then we have features and targets for the model. We use those to train the model. Alright, so what next? We have the trained model, then I take the portfolio. So portfolio, basically trained model goes into portfolio. Um, Alright, so there's a nice simple flowchart for us. So what was the point? I want to test, so I need an automated framework. All right, so let's do new flowchart. What is this? Why does it do that? I'll just make it in PowerPoint. All right, so steps. All right, so first step, specify model location, model folder, and portfolio strategy. So specify model folder and portfolio strategy. Um, so for each model portfolio strategy pair, generate and save predictions for the day. Um, retrieve positions from previous day, and record open data. So, okay, so it's not going to save the open because it doesn't know what the open is, but then the next day when it pulls the data to get predictions for that day, it'll know the opening price of the previous day. So we want to record that then. Retrieve positions from previous day and record open data, and then iterate through previous positions. Record number of days to hold. Iterate through currently held positions. If today is the sell date, okay, so if today is not the sell date, we can start with record number of days to hold and how many, and number of days held as 0. If today is not this, if is not equal to, hi buddy, if the number of days to hold is not equal to the days held, so let's say we're holding for 1 day, it'll be 0. Okay. Otherwise, if number of days to hold is equal to days held, leave purchase prices as net. Okay, so these should be subpoints. Record number of days to hold and number. Okay. Iterate through currently held positions. If number of days to hold is not equal to days held, increment number of days to hold. If number of days to hold is equal to days held, if open is equal to false, We also want to record whether it's long, short. And then we could say if open is equal to false. So if it's closed, okay, so open is set to true. If the number of days to hold is equal to the days held, then the open is set to false. But this won't run because this happens first. So if open is equal to false, get open price from previous day as the close price of the position. Okay, close price and profit should be nan. And then we need to put it in a CSV. So what should that look like? I mean, that should be pretty easy, right? We could just do like, so we can just do date, type, long, short, ticker, prediction value, and then we want days to hold. Steps for recording a single strat. What are you whining about there, boy? What do you want? You want out of the room? You want up on the bed? What do you want? You want out? You just want some pets? You want attention? Good boy. There you go. I'm out of coffee. All right, I'm out of coffee, so I'm gonna go get a Mr. Pibb. Alright, so each strat should have its own folder. That's pretty good for paper trading, I think. Okay, now let's look at the GitHub and see what's been updated. Alright, so before we get to that, let's just focus on some portfolio strategies that work. So, what did I do here? 5 positions, 1 day, 120-day look back, smooth true, 1.5, 15, beta neutral, 0.08. Okay, so all I did was tolerate a little bit more volatility. Okay, so with higher volatility, the only difference between these two is this one's using 8% volatility, so you see the returns are a lot lower, but the drawdown is only 25% at its worst. The returns is about 12x over the whole 12-year time period. Here the returns are like maybe 17x over the whole time period, but the worst drawdown is clearly worse. Now, I don't need 12x returns over the whole time period. I'd be happy with like, much lower returns. So let's try stricter volatility scaler. The problem is, yeah, let's just try and see what this does, because the problem here is I wanted it to be scaling all the way up more a little bit in volatility. So it might be just too restrictive if I'm using lower volatility. But here, we have 0.05. What was this here? 0.08. So let's try that. Scripts. So we want explorers. And then let's do portfolio explorer. Okay, and then all these things are being added, but data/missing tickers. I don't even know what that is. Ignore. Alright, then we have agents. Ignore. This guy, obviously, ignore. I don't know why am I having trouble ignoring that? I'm not sure. Alright, this we don't need. Don't need that. Ignore that whole folder. I could just ignore other data. Ignore paper trading folder. Alright, so here's the new results. So once again, we're getting a lower drawdown with lower returns. And yeah, I'm just worried because it's almost always, it's like the average is like 50% exposure. So I'm kind of worried about that. But we could try even more restrictive volatility scalar. Okay, so you can see the pattern here. 8% volatility threshold, we're getting 12x returns. 15% 12% threshold, we're getting like 17x returns. So higher returns. Drawdown here, 8% threshold, 25%. With a 12% threshold, it's 35%. Here, we're using a lower threshold, so 5%. And the worst drawdown is about 20%, just over 20%. What about the duration? So 494, 494, 494. So that's not an improvement. Yeah, so 8% volatility, we're getting about 10x returns, 25% drawdown. 12% volatility, we're getting higher returns, about 17x, but a higher drawdown, about 35%. When I lower the volatility threshold to 5%, I get a lower return, but still pretty good, about 7x over that 8-year time period. And the worst drawdown is about 22%. So let me try a really restrictive volatility scalar, and we'll see how that works. 0.02. Let's go back. Yeah, so even though the drawdown duration is, even though the drawdown is lower, the drawdown duration is still the same. So let's try just like 2% target and see how that changes things. I think about it over and over again. Hey. So the drawdown duration is still the same. Yeah, I just think that's way too strict. But the drawdown amount is better. Okay, so but returns are lowest and exposure rarely approaches 1. So let's try changing the window. Let's go back to 0.08, I think that was. With a longer look back. Okay, so first thing is hey, McLovins, how are you? Damn what? Or do you mean the civil infrastructure? You're just a fan of dams. Alright, so here's the result for the longer look back. Well, that clearly looks worse. Ah, I didn't save it. So let's try making a plot. Let's actually make a new folder first. And let's save this. Okay, so let's start tracking some of this data. No. Beaver dams are cool. I don't really know much about them though. No, I never day trade. This model is really swing trading, but once I implement it, I will be trading every day, just in separate tranches. So I don't know if you'd call that day trading. Once the model's going, I am making buys and sells every day, but I'm making 5-day trades, so that's really swing trading. All right, let's document this. Also heard you say you would take less than a 12% return when we talking. Oh yeah, APY. I don't want less than a 12% return. I would like more than a 12% return, but over this whole time range, 2014 to 2025, that's 12 years. So 12x return over that time period is 100% per year. That's crazy. I don't need that. Yeah, so anyway. All right, so oh, we need to paste this in. That's right. Okay, so if we use a longer volatility look back, the returns are lower, max drawdown is worse. Okay, so we have 40-day look back. Let's keep working with this to get some data. So I also did 12%, 5%, and 2%. So let's do those. So 12%, 5%, and 2%. And then I'll do one more. We'll do... all right, so then we'll have 4 slides of this, and then we'll do the same thing. Okay, so that'll be the end of the 40 days. Then we'll do 10 days. 10 days. Okay, so if I lowered or I increased the volatility a little bit, the drawdown is slightly worse, but it's not, you know, nothing significant, but the return is a lot lower. So I'm going to try a lower volatility threshold now. So let's go back and try 0.05 and let's see how that does. So first I was using 20-day. So I guess the effect basically of a longer window is the scaling gets a lot less noisier. It's basically less responsive. So I think we want a shorter window, but let's try. So that was 5% volatility. Let's try 2% volatility. Let's document this first. We're going to put this in the PowerPoint. And then let's change this down to 0.02. We still have the 40-day look back. So now let's run that and see how it does. So that's obviously not very good. Oh, yeah, I'll show you my goals. I have a slide talking about my goals. I have two goals, and they're pretty simple. So first goal, beat the S&P 500 by a significant margin. We'll stay in market neutral. So the S&P goes up on average 6% per year. I want to do significantly better than that, 3 to 4 times better than that, and return 18 to 24% per year. But it should be market neutral. So I shouldn't have to worry about, are we in a bear market, a bull market? Regardless of what the market's doing as a whole, I should reliably be able to get my 18 to 24% yearly returns out of the model, no matter what. Now, my second goal, I'm writing all of this code in Python. So I have a second goal, which is to generalize all of the code, make a tool that anyone can use to create these sorts of models for themselves. Basically, increase the rate at which you can test. You can get started up and testing and running machine learning models for stock trading. So if you're interested in that, go check out the GitHub. The link's in the description. But you can do this whole everything I'm doing here at the bottom, defining a stock universe, creating a returns model, training the returns model, robustly testing the returns model, and finally implementing portfolio strategies and robustly testing those. You can all do all of that in under 100 lines of code. So if you're interested in that, check out the GitHub. But those are my two goals for this project. All right, so now we can decrease the look back to 10 days. And let's just start with 0.08. So 8% volatility. That looks better over the whole time until this year. 8% volatility with 10-day look back. We do get a nice noisy chart. So more volatility probably won't be better, but we'll see. Where the hell did that PowerPoint go? Oh, there we go. Oh, I forgot to save that. Slightly lower duration. All right, so 20-day look back. 8% volatility. We have a max drawdown of 28.51%. We have a total return, I'll say annual return actually, of 22.18%. We have a Sharpe ratio of 1.04 and a drawdown duration of 494. Here I was using a 5% threshold, right? Yep. All right, so that's 0.08. Now in 0.12, All right, 0.12 we have max drawdown of 33.99, annual return 27.23, sharp 1.05. Hey, it seems you're wasting time. Well, yeah, that happens. I never said I'm the most efficient guy in the world. Also 494 days. Okay, now 0.05. Max drawdown 23.09. So lower max drawdown, lower annual return. Sharp difference is negligible. Duration 494 days. So it's the same number of days regardless of the look back. So drawdown 15.02, annual return 11.18, sharp 1.03, and drawdown duration also 494 days. Dang it. Shoot. Well, I gotta run that again. What was the threshold? Oh, 0.05, so lower threshold. Let's try 0.12. Because I want to see... It should be worse, but let's make sure. Oh, so I did have that. Alright, let's delete this. So here we have 8% volatility. So So max drawdown 38.19. Annual return 19.76. Sharp 0.9145. So here's the 12% threshold. All right, so we got 8%, 12%. Let's do 5%. $40-day look back, 8%. Okay, so that's the sharp. Now drawdown duration, 658 days. Now that's for 0.08. Now for 0.12, we have 45.08% drawdown. Annual return of 23.7. Sharp is 0.899. Drawdown duration 669 days. So if we use 5%, we get a max drawdown of 30.6. Annual return 15.74. Sharp 0.92. Drawdown duration 643 days. And finally here, 2%. Max drawdown 18.61%. Annual return 10.23. Sharp Okay, now we can take this down to 2%. I keep looking for my drink, and I drank it already. Okay, so we're almost done with this. Let's finish documenting in this spreadsheet. So 40-day look back, 2% threshold should be here, right? Yep. Okay, Sharpe ratio 0.94. Drawdown duration 634 days. Okay, now 8%, 10-day look back. Max drawdown 38.15%. Annual return 21.33. Wait, so if, oh, I see. Sharpe 0.9828. Drawdown duration 444 days. So lower. Now, what about 12%? Same thing, still 444 days. Sharpe ratio 1.0115. Annual return 25.94. Max drawdown 41%. So here's with the 2% threshold, much lower return, but much lower drawdown. All right, so we finished this. Let's finish putting everything in. $0.05 with 10 days, max drawdown 17%. So 10-day look back is giving lower returns. Does it give lower draw? Oh yeah, it gives significantly lower drawdowns. Annual return. Oh no, max drawdown goes here, so 30%. Annual return 17.06. Sharpe 0.97. Drawdown duration 475 days. Whoa, so longer drawdown. So once again, it's the conclusion that I can't draw any conclusions. All right, so 2%. Max drawdown 18.67%. Annual return 10.49. Sharp. Drawdown duration 478 days. Yeah, so what if... So using the shorter look back doesn't really help things out too much. Let's make some plots. How do we add data? They used to have that thing. You click it and something pops up on the side. Yeah, how the fuck do I put this shit in? Um... Sorry, I'm not very good with Excel. Alright, so series 2. Name should be 40-day look back. X values should be these guys. Y values should be these guys. Okay. How do we add a legend? So the 20-day look back, wait, is that real? Is consistently lower. And the worst drawdown duration. What do we make of this? All right, let's think about this, and then I'm going to decide what I'm going to do next. For now, I have to go to the bathroom, so I'll be right back.
boy.
All right, so let's think about how to troubleshoot this, because basically what this means is 20-day look back is somewhere in the sweet spot when it comes to drawdowns. But am I plotting the correct thing? So drawdowns 15, 18, 23, 30. Yeah, so 10 days always higher drawdowns, lower drawdowns, I don't know. But more extreme drawdowns basically than drawdown. Okay, so let's add a title. So maybe you could say the shape of the curve is different. Maybe you could say with 40-day look back, we just need a higher threshold. So let's try a 40-day look back. How far are these points? Point 0.08, 0.12, 0.05. So it's like 3, 3, 4. I think I could do like 0.18 is reasonable. So I think the green is 10. Yeah. But that makes sense. But at some point, it's just going to turn into a flat line full exposure. But let's see how this works. So first thing we want to look at is test the hypothesis. Do these have diverging curves? Okay, so let's make sure this is saved. I changed the value to 0.18. And let's see how this does. So can I insert below? Why can't I insert below? Max drawdown. Okay, so now let's make this table the same. I'll do it for 20 days as well. Because then, maybe these curves will have some convergence. But of course they'll converge at some point. So maybe it's because with the 10-day, maybe this is just converging because there's going to be some drawdown amount with full exposure. So, probably we should add that to the plot as well. Can I put this inside the plot? All right, so let's get the format. Oh, okay, this finished now. And now we're getting closer to full exposure. Look at that. So we would have had, so if we keep increasing the allowable volatility, if we keep increasing the allowable volatility, the worst event in the history of the portfolio becomes the Iran war crisis and not COVID. So, that's interesting. Where did that PowerPoint? Oh. All right, so that was 18% with a 10-day look back. So the first idea was, is there some divergence? So divergence in the curves. So now let's try. Oh no, but if it's approaching the threshold, then the divergence should be. So it's the opposite. This one is curving like that, and that one has a stronger curve. Well, maybe it could just be the case that if we have a 10-day look back. Oh, if we have a 10-day look back, there's a lower max drawdown. That's probably what's going on. But it'll be interesting. I think actually this one will be more interesting to see. But actually, yeah, what's really interesting is that as, you know, maybe there's some valley in here, and 20 isn't the lowest. Maybe like 12 or something is down here. That'd be interesting. And actually, it will be interesting to see how the slope of the curve changes with the next data point. So let's put those guys in. What 0.18? .18. Okay. Then we could put the data in for the bottom one. $10-day look back. Max drawdown 46.14. Huge. I guess that's the pattern. I shouldn't be too surprised, but 46% drawdowns, enormous. 30.31% return. Sharp 1.0223. Drawdown duration 478 days. That looks not terrible. Oh, I should show it. So what's interesting here is the recent crash is over a series of negative months. You can see if you look at the monthly returns chart. Alright, so now let's do the same thing for 20 days. Did I save it? Yep. Alright, now let's put these values in. So 40-day look back, max drawdown, whoa, that is a lot. Max drawdown 46.75. Oh no. Where'd I get 46.75? It's 52.17. Annual return 28.52. Sharp 0.8905. Drawdown duration 670 days. Okay, so it will be interesting to look at these other variables. So let's look at let's add a title to this. Should be bigger. Solid fill. Let's also make it white. Text options. I don't get this at all. What the hell? This is not useful. Why don't I just make it bigger? Simple as that, I guess. Okay, and this finished. I was busy on that, but here's the results. For the 20-day look back. And 18% volatility threshold. All right, so this was, I believe we're looking at 40-day look back, 10-day look back, 18% 20-day look back. So this is a lot of slides just for one portfolio strategy, but I need to document. So let's put these values in, and then we'll extend the lines. Wait a second here. I have to check to make sure that's right. Why did... So let's see. 0.05 10-day look back. Ten-day look back. 8%, 12%, 0.05. Ten-day look back. And what are we looking at? Drawdown duration is 475. Yeah, that's right. All right, now finally for 0.18, 10-day look back, 478. Yeah, that's correct. So I just don't have 0.02. So 478 here as well. For 0.02? Huh. All right. Oh, drawdown. Max drawdown. All right, so we could finish filling this out. Max drawdown is 52.17. Wow. So big increase. Whoa. Annual return 28.52. First off, let's look at the Sharpe ratios. So here, increasing the volatility increases the Sharpe, increases the return, and increases the drawdown. Here, increasing volatility decreases the Sharpe. So the exact opposite relation. And increases the duration of the drawdown. Here, increasing the volatility increases the Sharpe. Hey, buddy. So Sharpe ratio well, the next thing would be to look at something in between. So let's do a 30-day look at back. And let's start with 0.08. There's good separation there. And that's where I typically start. Alright, well, I have to finish documenting this and then give the stats, and then I have to run through a 30-day look back and 15-day look back and see if I can find any patterns here. So that's going to be it for now. I'm going to go eat some lunch, but tune in if you're interested. In a few hours, I'll do another stream, and I'm going to finish looking at this single portfolio. Then I'm going to go ahead and try a fairly different, model and portfolio strategy, and try to see, do these rules kind of hold? Am I going to do such an in-depth analysis for everything? If I am, I can kind of hold off on building the infrastructure for the day trading for now, and just manually. That actually might be the most desirable thing, is just do one model to start with. And then I can do a really comprehensive analysis of the portfolio, and be more confident in that. And then then that will give me an idea for what I want to look at for the, I can use what I learned from that to build the live paper trading framework basically. And I'll have a month of paper trading anyway to do. So that will give me, experience to build the live trading with real money framework. So anyway, that's it for now. Thanks for watching. Don't forget to subscribe and have a nice day. Adios. Live paper trading framework basically. And I'll have a month of paper trading